Hello and welcome back to the channel Implied Investing. Today is going to be a shorter video because we got a lot of news to go over, but I wanted to talk about what war with Iran means for your income portfolio. If you've been paying attention to the news, then you know that the US and Israel have struck Iran. But before we get into that, let me go ahead and give you the legal disclaimers. This is not financial advice. I'm not a financial professional. Before This is for entertainment and educational purposes only. Before making any financial decision, please seek out a qualified financial advisor. So I wanted to start by just letting you know that at Implied Investing, we are not a geopolitical channel. Whether or not you support the strikes, whether or not you disagree with the strikes, that's not what this channel is about. But as a service member, I wanted to let you know what advice I'm giving to my brothers and sisters in arms and what advice I would give to anybody, and especially followers of this channel. Excuse me. Um, I found this quote. It says, when the world gets uncertain, your money still needs a mission. And I know a lot of people have a lot of uncertainty about how the market is going to react. So I decided to make this video to try to give you a preview of what might happen. Not will happen, but what might happen. So, what happened this weekend? The U.S. and Israel launched joint strikes against Iran in Operation Epic Fury. The targets were Tehran, Isfahan, Qom, Karja, Kermanshah, military bases, and nuclear infrastructure. There's been retaliation. Iran has launched missiles against 27 U.S. bases in the Middle East and Israel and military targets as of when I'm recording this. But they also launched missiles against Saudi Arabia, UAE, Bahrain, Jordan. They've been attacking their neighbors. And the escalation potential is that their supreme leader was killed. Several IRGC commanders were killed, and they are vowing revenge. So, what is that going to do with to the markets? Historically speaking, the markets dropped during the Gulf War in 1990, dropped about 16.9%. The Afghanistan War in 2001, the markets dropped 11%. Iraq War, 5%. Russia Ukraine, the markets dropped 6.8%. Iran Israel 12-day war, the markets dropped 4.2%. So you can expect a potential drop. This is not guaranteed, but markets almost always drop on conflict escalation, then recover within months. The investors who bought the dip were rewarded Monday. I'm sorry, were rewarded. Monday will likely be red. This is an opportunity. What I'm doing and what I can only say that I'm doing, I cannot give the same advice to you because me and you are in two completely different situations. But what I'm doing is I'm buying the dip. There's a good chance that the market is going to gap tomorrow on Monday, so it'll already be going down. If you have a DCA, now is the time to DCA. But here are some of the factors that are causing that are going to cause the shock. The Strait of Hormuz are disrupted. Iran hasn't completely closed them yet, and I don't think that they have the ability to completely close them, but they are disrupted, meaning that there's a greater likely chance that anything going through the Strait of Hormuz is going to be attacked than not. Uncertainty premium, multi-day operation confirmed. So the U.S. will be and Israel will be carrying out these strikes for several days, and I'm sure Iran will be retaliating for several days. So just know that the markets hate unknowns. The VIX will spike, equity sell off, flights to safety. So people are going to be going into things that oil prices, for one, are probably going to go up. Gold, silver, could go up also, but there will 100 almost 100% chance be that people are going to be risk off. What I want to encourage you to do in this time and what I'm doing is don't panic sell. Do not panic sell lower than your cost basis. Okay? Crypto volatility, Bitcoin, crypto positions, block ISSB, ISSB face dual risk. Risk off selling plus potential exchange disruptions. Expect heightened swings. So you guys, if you're heavy into Ethereum, if you're heavy into um, Bitcoin, be expected to potentially drop tomorrow. Nobody knows for sure what's going to happen. These are all scenarios. Historically, the market does drop, but we don't know. But whatever you do, do not panic sell. Do not panic sell because historically the markets recover. Okay. Moving on. So what am I doing tomorrow? I'm buying the dip. I am buying the dip. In fact, I'm going to double my DCA. I'm going to double my dollar cost average. And why am I doing that? Because my investment thesis has not changed. If your investment thesis has changed, if you think war with Iran is going to change the world and the future forever, then your investment you shouldn't follow the advice that I'm about to give. But my investment thesis is that AI is going to change the way business is done in less than 1,000 days. That's 3 years. 1,000 days is roughly 3 years. AI is going to completely change the way business is done. That's number one. Robotics is going to change the way we live our life. That is thesis in less than 1,000 days. That is thesis number two. Thesis number three is that energy needs are going to grow. AI and robotics use tons and tons of energy. That is thesis number three. That energy is going to grow with AI and robotic needs. And four, digital currencies will grow. I don't have anything particularly insightful to say about fiat currencies, but what I can say is that in the long run, I do believe that digital currencies will grow. Which ones will grow? I can't tell you. I can't tell you. It could be stable coins, it could be blocks, it could be Ethereum, it could be Solana. I don't know. But I do know that digital currencies will grow over the long term. So that the because my long-term thesis, regardless of the war with Iran, has not changed, I am still investing. And because prices are going to drop, I feel like I'm able to buy it at a discount. All right. Moving on. I already gave it away. What I'm doing, I'm doubling my DCA. If your regular DCA is $200 a week in your income portfolio, this week double it to 400, right? Don't spend all your dry powder because markets can continue to drop. It's probably not going to drop 11% in the first week, but maybe it takes 2 to 3 weeks for it to drop 11%. But here's what's important why this works. Lower share price means more shares and more distributions. And keep your income ETFs, and this is the benefit of not just growth investing, but income investing, is that your income ETFs keep paying you through the volatility. And the more of those shares you have at the lower price, the more money you're going to make. And those prices, as they recover, historically within at least a year or a couple months, you're going to benefit significantly. This is where money is made. I can't stress that enough. I know it feels like you shouldn't be investing, but this is where real wealth is made. Conflict dips historically recover in weeks to months. That's why I said within the year, it's historically will recover. Example, if KYLD drops 5% on Monday, your $400 buys more shares at the discount, and those shares start paying weekly distributions immediately. More shares equals more income every single week. Multiply that across other. I use the holdings that I'm going to be DCAing into. Um, your 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 potential benefit is humongous. Okay. So what exactly am I buying more of? I'm buying more KYLD. KYLD holds crypto, it holds gold. I'm sorry, it holds gold and silver miners. It holds volatile tech stocks, but not so volatile that they're not going to be around. Like they're pretty solid names, but they are future oriented. TDAC, this is tapping alphas, and it pays. I'm sorry, KYLD pay is currently paying about a 25% yield. It, I know it used to be at 30%, but it's no longer there. Howard Chan went on a YouTube and said that they're dropping their distribution to defend the NAV, and I love that. And that also gave me more confidence to invest in them because I know that my stock price isn't just going to plummet; they are going to defend the NAV, and that's important. TDAC pays 17.3. It's a zero DTE covered call strategy on QQQ, which is the Nasdaq. T-SPY pays 14.3% daily covered calls on the S&P 500. XQQI is Neos's 1.5 leveraged strategy on the Nasdaq. Uh, Very good. It has 1256 options income. I'm going to buy this. I'm going to buy this during a drop. I'm going to buy this during a drop because, and I know this sounds crazy because it's a leveraged fund, but as I buy during the drop, not immediately when markets open, I'm going to get a lower and lower cost basis, and this fund is still going to pay that 21%. I don't think that the whatever's happening is going to destroy the market, but I do think that there is going to be a drop and a great buying opportunity. I'm also buying XSPY, which is their covered call strategy on the S&P 500, and I am buying more blocks. I am doubling my DCA on all of these funds. I'm buying more blocks because my long-term thesis has not changed, and these funds are going to pay me while I wait for the market to recover. While I wait for the market to recover. In this presentation, I don't have my long-term portfolio, and mind you, this is just a 6 out of 9 funds that I have in my income portfolio, but these are the 6 that I will be doubling my DCA in because I think there's incredible opportunity to get a great deal of income. All right, so here's your battle plan for Monday. I should have did this. I should have gave you a bluff, which stands for bottom line up front. It's don't panic sell, WDCA, load up on your income factor. I know it feels scary. I know a lot of investors are risk off right now, but if you listen to any seasoned investor, they say when everybody is risk off, you need to be risk on. And I'm testing that philosophy. This is only what I'm doing. I can't tell you what to do. And stay the course. Even if you decide not to double your DCA, continue your dollar cost averaging. This is where you're going to really accumulate shares of great companies at a low price. For those of us I'm talking to my fire investors now, for those of us who are still in a accumulation phase, the people who are selling off is going to be the big money. The big money is going to run the funds like SCHD because SCHD is 20% energy. It's a real solid long-term blue chip fund. But if they're going to run to that because they've already accumulated their money, what they're trying to do is not lose any money. And people who are in their accumulation phase of their fire journey are probably should be more risk on because you need to you're building up your money, and accumulating these shares is a great way to do it because the market's going to recover and you have time for it to recover. Historically, it recovers in months, but it could take years. It could take years. People who already have hit their goals, their income goal, I'm sorry, their hit their fire number, their financial independence retire early number, they don't want to play that. They don't want to play this game. They do not want to play this game. They want safety. They would go to cash, they would go to bonds before they went back into equities. But because if you're still in your accumulation phase, run to it. Run to the dropping price and get in. Okay. Um Lastly, last quote, in uncertain times, the disciplined investor builds generational wealth. With that, I'll go ahead and close the video. Please like, subscribe, leave your questions in the comments, and please pray for our soldiers. Please pray for this world, and God bless.